On the morning of March 9, 2023, Silicon Valley Bank was the 16th largest bank in the United States. It held roughly $209 billion in assets. It had been in business for 40 years. It banked a very large share of America's venture-backed technology startups. By the end of that same day, its customers had tried to pull $42 billion out of it, not over a month, not over a week, in a single day. By the close of business, the bank's cash position was negative $958 million. 44 hours later, it no longer existed. Now here's the part almost nobody talks about. Silicon Valley Bank was not committing fraud. It wasn't gambling on crypto. It hadn't handed out a pile of reckless loans to people who couldn't pay. It had done something that sounds boring, prudent, almost virtuous. It had taken its customers' deposits and bought United States government bonds, the safest asset on earth. And that is what killed it. To understand how that's even possible, you have to understand something most people have never actually been told. What a bank does with your money after you hand it over. I'm going to show you. And I think by the end, you won't look at your bank balance the same way again. Let's start simple. You deposit $1,000 into your checking account. Where does it go? Most of us carry around a vague mental image of a vault, your $1,000 in a stack with your name on it, waiting for you. That image is completely wrong. Your $1,000 does not exist as $1,000 sitting anywhere. The moment it lands, it stops being your money in any physical sense and becomes something else, a promise. Here's what actually happened, legally. You didn't store money at the bank. You lent it to the bank. You are, right now, an unsecured creditor of a financial institution. That number in your banking app is not a receipt for stored property. It's an IOU, and the bank spends it immediately. Now, you might have learned in school that there's a limit on this. The fractional reserve system. The bank keeps 10%, lends out 90%. That was true. It isn't anymore. On March 15, 2020, the Federal Reserve announced it was cutting the reserve requirement ratio to 0%. Effective March 26, 2020, American banks have not been legally required to hold back any fraction of your deposits. None. And here's the strange part. Almost nothing happened. No hyperinflation, no collapse. Because the textbook model was never really how it worked. Banks weren't constrained by reserves. They're constrained by capital requirements, by regulation, and by whether they can find someone creditworthy to lend to. The 10% rule was a monetary policy tool, not a safety mechanism. When it disappeared, because the system had never really depended on it. So if your $1,000 isn't in a vault, and there's no legal requirement to keep any of it, where is it? It's out in the world. Some of it is somebody's mortgage, some is a small business loan, a chunk is government bonds, a portion sits as reserves at the Federal Reserve, quietly earning interest, and a genuinely small slice is physical cash in branches and ATMs. Your money isn't stored, it's deployed. So how does the bank make money doing this? The core mechanism has a name, net interest margin, and the idea is almost embarrassingly simple. The bank pays you a little to hold your money. It charges someone else a lot to borrow it. It keeps the difference. Say your savings account pays you 0.5%. The bank takes that money and writes a mortgage at 6.5%. That gap, 6 percentage points, is the bank's revenue on your deposit. You did the saving, they collected the spread. Across the whole American banking industry, this is the engine. In the first quarter of 2026 alone, U.S. banks reported $80.5 billion in net income in 3 months. But interest is only the first stream. There are 3 more, and they're the ones you feel more directly. Second fees, overdraft fees, monthly maintenance fees, wire fees, out-of-network ATM fees, insufficient funds fees, each one small, multiply by millions of accounts, and it becomes one of the most reliable revenue lines in the business, and one that doesn't depend on interest rates at all. Third, interchange. Every time you tap a card, the merchant pays a fee and a slice of it goes to the bank that issued the card. You experience this as free and convenient. It is neither. The cost is paid by the merchant, and then quietly built into the price of everything you buy. Fourth, for the largest institutions, everything else. Wealth management, investment banking, trading, custody, advisory fees. So when you ask how does my bank make money, the honest answer is that it earns on the gap between what it pays you and what it charges everyone else. And then it earns again on the mechanics of you moving your own money around. You are not the bank's customer in the way you probably think. You are the bank's cheapest source of funding. Now we can go back to Silicon Valley Bank. Because there is a structural problem buried inside everything I've just described. It has a name too. Maturity transformation. Here's the mismatch. Your deposit is available on demand. You can withdraw it this afternoon. But the bank has lent that money out for 15 years, or 30, or put it into a bond that doesn't mature until 2050. Short-term promises, long-term assets. Every bank on earth runs this mismatch. It isn't a flaw in the design. It is the design. It's the only reason a 30-year mortgage can exist. Nobody wants to lock their savings away for 30 years. Everybody wants to borrow for 30 years. The bank stands in the middle and absorbs the contradiction. And it works, as long as depositors don't all want their money at the same time. Now watch what happened. Between 2020 and 2021, deposits flooded into SVB from technology startups. Enormous amounts of cash it had to do something with. So it bought government bonds and mortgage-backed securities. Safe, boring, long-dated, bought at a moment when interest rates were near zero. Then, the Federal Reserve raised rates at the fastest pace in 4 decades. Here's the thing about bonds that trips almost everyone up. When interest rates go up, the market value of existing bonds goes down. If you're holding a bond paying 1.5% and brand new bonds are paying 5%, nobody will buy yours at full price. They'll pay less. SVB's bonds were still perfectly good. Hold them to maturity, you get every dollar back. But their market value had collapsed. By early 2023, the bank was sitting on billions of dollars in unrealized losses. Unrealized, paper losses, harmless, as long as you never have to sell. To cover the outflows, SVB had to sell about $21 billion of those bonds, at a loss of $1.8 billion. And on March 8th, it announced that publicly. The paper loss became a real loss. The real loss became a headline. And the headline hit a customer base that was unusually concentrated, unusually online, and unusually well-connected. Venture capitalists and founders in the same group chats. Within hours, they were telling each other to get out. $42 billion in one day. And this is what made 2023 different from every banking panic before it. A bank run used to require standing in a physical line. Now, it requires a phone. A run that would have taken a week in 1930 took an afternoon. And this isn't just history. As of the first quarter of 2026, unrealized losses across the entire U.S. banking system stood at $325 billion. That's actually a big improvement. At the peak, it was over $600 billion. But it's still there. The same mechanism, sitting on the same balance sheets. So, should you be worried about your own money? For most people, honestly, no. But it's worth understanding exactly why. Because the protection is real and it has edges. If your bank is FDIC insured, your deposits are covered up to $250,000. But the phrasing matters far more than the number. It's $250,000 per depositor, per insured bank, per ownership category. Read that again, because almost everyone misreads it. It does not mean $250,000 total forever. Someone with a personal account and a joint account with their spouse at the same bank is covered separately for each. Those are different ownership categories. And someone holding accounts at 3 different insured banks has 3 separate limits. Why does this matter? Because it's exactly what went wrong at SVB. Its customers weren't ordinary savers. They were companies holding payroll, tens of millions of dollars in a single account. The overwhelming majority of SVB's deposits were uninsured, which is precisely why those depositors ran so fast. They had every reason to. If you're an ordinary depositor, under the limit, at an insured institution, the practical risk is close to zero. So what you should take from this isn't fear, it's literacy. Know whether your institution is actually insured. Know your limit and know your categories. And if you run a business holding large balances, understand that the limit was never designed for you. That's it. That's the whole action item. Here's what I keep coming back to. We describe banking as if it were storage, safekeeping, a vault. And that language is doing something. It's hiding the actual product. A bank does not store your money. A bank takes short-term promises and turns them into long-term investment. It's a machine for converting patience into buildings, businesses, and homes. And the whole structure stands on one thing: the shared belief that everyone else will stay calm. That isn't a weakness in the system. That's the deal. Every mortgage, every business loan, every expansion financed by a bank exists because that mismatch is permitted. Silicon Valley Bank didn't die because it was reckless. It died because it forgot that the belief holding it up was fragile, and that in 2023, belief travels at the speed of a group chat. Your money isn't in a vault, it's in the economy, which is a far more interesting thing than sitting still, as long as you understand what you actually agreed to. I'm going to keep taking apart the systems that quietly run your financial life. If that's useful, subscribe, and I'll see you in the next one.